All right, everyone, good evening. Today is Monday, October 5th, and we're going to run through the market news of the day. To kick things off, let's talk about the tone in the equities markets. We see that it was incredibly strong across the board, with the S&P 500 up nearly 2% and the Dow up a little bit more than 1.5%. We saw similar movements in the NASDAQ, up 1.5% as well. On the right-hand side of the screen, you'll see the Treasury yields considering the 2-year, the 10-year, and 30-year yields. The 10-year and 30-year just hit their nearly 4-month high, which contrasts the high that the 2-year just hit, which was a 1-month high. It's pretty logical that these did rally coming out of, obviously, the concerns over Trump's health, the question of future stimulus, and the idea that now, since Trump is back in the White House as of just a few minutes ago, he may push for a stimulus package after his hospital discharge. Obviously, we have the Republicans down at about 1.7 trillion and the Democrats insisting on 2.5 trillion. So Pelosi spent about an hour on the phone today with Secretary Mnuchin going through possible options for different stimulus plans. Considering the Treasury curve, though, we did see steepening across the board, with the 10-year up 6.5 basis points, the 30-year up 8.5 basis points, and the 2-year rallying in turn as well. We do see continued fears of increased deficit spending, which are likely to arise from a Democratic election. So if Biden does become president and there is a sweep in Congress and it does become more blue, there is likely inflation because of those different things. In addition, we see that gold continued to rally amid a weaker dollar, and resilient economic data from the ISM showed that services sector non-manufacturing rose to 58%. So the way these data points are kind of calculated is anything above 50 means it's expanding, and then the difference between what the value is and 50 indicates how fast it is expanding. So it expanded at a rate of 57% in August and was up to 58% last month. So pretty good numbers going into the election. We'll see if it's enough. Obviously, the spread between President Trump and the presidential candidate Biden is pretty large right now. I think polls have it around 14 percentage points, which is pretty substantial. However, I would duly note that there are big gaps going into the election of 2016, in which President Trump obviously did win the electoral nomination there. So it'll be interesting to watch. Exciting times ahead. All right, talk about some deals and corporate changes. The first thing on your screen is Ant Group, the Hong Kong and Chinese listings. This is China's biggest mobile payments company, and it's a financial technology group that had spun out of Alibaba in 2011. It's expected to be valued at 200 to 300 billion US dollars. Caixin, the Chinese news source, stated that Ant Group is hoping to sell about 10% of its shares on Shanghai's version of the NASDAQ. It's dubbed the Starboard, and sell about 5% on the Hong Kong Stock Exchange. So the idea is to do a dual listing here. Alibaba currently owns a mere 33% of Ant Financial. However, Jack Ma owns 8.8% independently. So that means he does have more than 50% of the voting power of this company. A couple people that are going to benefit from this IPO are Carlyle, the Canadian Pension Plan Investment Board, and General Atlantic, the growth equity investor, because they've been backers of the company that have dominated the mobile payment sphere in China, with 711 monthly users of its Alipay app. So that'll be something to watch in the coming days. They filed back in August, and it looks like their IPO should happen very soon. ExxonMobil is to add 1,600 jobs in Europe, which is not surprising given, firstly, the low prices of oil. You've got WTI still below $40 a barrel, looks like $39.50. We see oil producers cutting jobs across the board. BP said in June that it would axe 10,000 jobs to help cope with the impact of the pandemic. And obviously, when they're referring to the impact of the pandemic, that is the negative demand shock to the prices of oil, which has dramatically lowered the price. In addition, companies like Royal Dutch Shell and Schollimber have also proceeded to continue with job cuts, with Shell cutting 9,000 positions and the world's largest oil field services company, Schollimber, in the process of downsizing its workforce by a whopping fifth, so 21,000 roles. Just to dive a little bit deeper into ExxonMobil, they employed 75,000 people worldwide in 2010, and these job cuts are going to amount for more than 10% of the European workforce. Moving on to the third item on the screen, we see that the Weir Group is to sell the oil and gas divisions to Caterpillar, with shares surging on the news. They moved up about 22.5%, making it the best day in over 20 years. Weir is selling the oil and gas division to the U.S. heavy equipment maker Caterpillar Incorporated for 405 million US dollars entirely in cash. The engineering company focuses on the mining businesses, and the idea is that it's going to follow a collapse in global oil prices. Obviously, we've seen bankruptcies across the board in the sector. We've seen, when we talked about high yield bond issuance a couple days ago, we saw substantial amounts of high yield bond issuance by companies that needed lifelines in these sectors, whether that's oil, gas, energy, however you want to call it, anything that's dependent on demand for oil, demand for travel, and demand for increased production. Also, in this acquisition, it is important to note that we will see a 70 million US dollar US cash tax benefit for Weir because of continued net operating losses, which will be carried forward into the new entity under the Caterpillar umbrella. The oil and gas business has had gross assets just shy of 1 billion US dollars as of June 30th this year. Obviously, since then, it's probably slightly lower given the fall in oil prices. However, that's still a pretty substantial asset to get. All right, moving on to the last thing on the screen, we see NTT buying Docomo. For those familiar with, telecom in Japan, you'd imagine NTT was already Docomo. However, they are going to launch a $40 billion buyout of the wireless unit of Docomo, which is the part of Docomo that they do not yet own. They're spending 4.25 trillion yen, which is the equivalent of 40 billion US dollars, to take the wireless carrier business private. This is the path to lower prices as the government continues to call for cuts. The NTT will launch Japan's largest ever tender offer for this 34%, of NTT Docomo stock that it does not own. So they'll offer nearly 4,000 yen per share for a premium of 41% to yesterday's closing price. Obviously, this is pretty substantial, and not surprisingly, Docomo rallied to their upper limit on the news. Touching base on the last point on the screen, we see KKR-backed Academy Sports falling a whopping 7% in its debut on the NASDAQ. It raised 203 million US dollars in its IPO with a sale of nearly 16 million shares. The giant KKR private equity mega fund backed retailer opened at $12 and ended up obviously falling from its IPO price of $13 a piece. It had intended to IPO between $15 and $17, valuing the company at a little bit over 1.07 billion US dollars. Credit Suisse, JP Morgan, KKR, and Bank of America Securities were the lead underwriters for this deal. All right, so that pretty much covers it for the news of the day. If anyone has any questions or wants to jump in, please do. But yeah, look forward to seeing you tomorrow and continuing the conversation.